talk about oil, because today it is sitting with an uptick of nearly 0.5%, although it declined 0.5% in trade yesterday. But this week so far, it has gained over 3%. So clearly, we are seeing an uptrend when it comes to oil prices, with oil prices surging 3% for the week so far. Now remember, we had reports from IEA and OPEC coming over the last 2 days. And first up, steady outlook for global trade in 2026 is the outlook coming in from OPEC Plus that came in yesterday. They are now seeing balanced approach despite predictions of a surplus, and they say that the world needs to produce an average of 43 million barrels per day to balance trade. So that's the word that is coming in from OPEC Plus, where they've not gone ahead and changed their forecast when it comes to oil's demand and supply for calendar year 2026. But on the flip side, IEA, or International Energy Association, has gone ahead and trimmed their forecast for the next year. In fact, they say they've gone ahead and reduced their forecast for this year and for next year, where they are now saying that surplus and supplies will now exceed demand by about 3.815 million barrels per day in 2026. They've also trimmed their surplus estimates by as much as 231,000 barrels a day versus their earlier estimates. So they clearly believe that surplus is likely to increase in the future, and that is the reason they've gone ahead and trimmed their forecast. Now remember, demand continues to remain strengthened. Output growth has been slower than expected. So these are the two parameters which they have factored in when they trimmed their estimates for calendar year 2026. So that's the latest on the oil market, which continues to remain in focus. And as I mentioned, it has gained nearly 3% for the week so far, and it is now trading near that $62 per barrel mark in the global market. But as promised, let's shift focus to some long-term trends then. And EU's Carbon Border Adjustment Mechanism, or CBAM, is set to fully kick in from 1st of January 2026. And under the new regime, Indian steel exports will attract carbon duties that are linked to their emission intensity, a move that is expected to raise costs and dent competitiveness in the EU market for India's steel exporters. In fact, recent data also shows that India's steel exports to the EU have already slipped by nearly 14% in the first 10 months of the transitional phase. To unpack what this means for the entire steel industry and the road ahead, we are now joined by Mr. Sachin Shetty, CEO of Quesrow. This, remember, is BigMint's consulting partner. Mr. Shetty, afternoon, and thank you so much for joining us here on ET Now. If you can take us through how this new mechanism, CBAM, Carbon Border Adjustment Mechanism, is likely to impact international steel trade in calendar year 2026, and how will India in particular be impacted on account of this?
CBAM will reshape the global competitiveness as it's set to become an equalizing mechanism. We see that it is now moving from reporting to real financial impact. We see three things that global steel trade will go through: reprice trade flows, shift in volumes from Europe to other geographies, and harder entry barrier, where we see CBAM makes carbon transparency and MRV capability a prerequisite. India specifically, we export 45% of exports to EU, and the largest premium market. It will lead to meaningfully erode our price advantage. There could be margin compression. European buyers on the Indian mill or the Indian mill have to absorb through the lower prices or margins. Over time, if we don't decarbonize, India risks becoming a price taker in lower value markets.
Okay, and Mr. Shetty, if you can take us through how Indian steel makers are now preparing for the new mechanism in the EU, and what strategies will Indian steel makers then have to adopt to serve to traditional export markets like the EU and to compete against low emission steel exporters such as Turkey?
Broadly, there are three parallel tracks that I foresee. One, which is measurement and compliance first. Plant-wise MRV systems measuring embedded CO2 at the product level, hiring verifiers and building internal carbon accounting teams. The immediate priority is don't pay the default values, pay on measured emissions. That is the priority. Second is progressive decarbonization of the route mix, exploring alternate raw material mix, processed routes, energy mix. The third one would be a commercial strategies to defend markets, like focus on higher value, higher margin products like API grade, automotive, plates for windmill towers, and electrical and other special steels. Specifically against Turkey, who are historically EAF heavy exporters, Indian mill would use product mix, reliability, and long-term contracts rather than pure price.
Understood. And Mr. Shetty, do you believe that an India-EU trade deal, which is currently underway, can be concluded in such a way that it will lower the impact of CBAM on India's iron ore and steel exporters?
Trade agreement cannot switch CBAM off totally because it falls under the Brussels frames CBAM, and it treats this as an environmental and climate tool, not a tariff. It's part of the EU Greens deal architecture. So a trade deal will not eliminate CBAM, but it can sharpen the credit India gets for its own climate policies and reduce the net burden on Indian steel, especially if we move quickly on our domestic carbon market.
Understood. So that's with respect to other factors. But the EU CBAM default values were recently leaked, and there is significant opposition even within the EU bloc members on the calculation of default values for CBAM and prospects for carbon leakage. Do you think these developments will affect the final design of the entire mechanism and its effective implementation?
So we are already seeing some friction inside Europe on the level of default values, on the administrative burden for small importers. We all know there's significant amount of SMEs, in Europe contribute to close to 35 to 40% of the manufacturing output. So on the concern that CBAM might simply shift emissions, not cut them, we don't have to bank on CBAM, going away. It stays, but expect that the parameters, including the default values, likely to evolve.
Okay, so that's the kind of impact India's steel and iron ore exports are likely to see on account of new mechanism in the EU. Mr. Sharma, thank you so much for taking your time out and joining us here on ET Now. But several commodities